electronic boards showing live ticker updates of the shares of companies listed on a stock market. Figure 15. 1. Investing can often provide great returns, but it can also be a risk. Credit. Modification of work e-ticker by Clipgame/Wikimedia Commons, public domain, chapter outline 15. 1. Risk and return to an individual asset 15. 2. Risk and return to multiple assets 15. 3. The capital asset pricing model, CAPM 15. 4. Applications in performance measurement 15. 5. Using Excel to make investment decisions. Having finished her college degree and embarked on her career, Maria is now contemplating her financial future. She is considering how she might invest some of her hard-earned money. As a short-term goal, she wants to build an emergency fund so that she could cover her expenses for 6 months if she became ill or injured and had to take time off of work. She would also like to save money for a down payment on a home and to purchase new furniture. Although she is not yet 30 years old, Maria also knows that it is prudent to begin saving for retirement. What should she do with her savings? Maria has some friends who have told her how successful they have been investing in stocks. Bart bragged about doubling his money in just over a year when he purchased Facebook stock, and Tiffany quickly tripled her money when she purchased shares in Netflix. But Maria also knows that her uncle lost a significant amount of money when his Boeing stock dropped from over $300 per share to under $150 within a couple of months at the beginning of 2020. Just how risky would it be to invest in stocks? What type of return might Maria expect? Are there strategies she could follow that would allow her to avoid her uncle's fate? Learning outcomes. By the end of this section, you will be able to compute the realized return from an individual investment, compute the average return and volatility of returns from historical data, describe firm-specific risk. Measuring historical returns. Risk and return are often referred to as the 2 Rs of finance. Investors are interested in both risk and return because understanding one without the other is really meaningless. In terms of investment, the concept of return is fairly straightforward. Return is the benefit or profit the investor expects from an expenditure. It is the reward for investing, the reason an investment is made in the first place. However, no investment is a sure thing. The return may not be what the investor was expecting. This uncertainty about what the return will be is referred to as risk. We begin by looking at how to measure both risk and return when considering an individual asset, such as one stock. If your grandparents bought 100 shares of Apple Inc. stock for you when you were born, you are interested in knowing how well that investment has done. You may even want to compare how that investment has fared to how an investment in a different stock, perhaps Disney, would have done. You are interested in measuring the historical return. Individual investment. Realized return. The realized return of an investment is the total return that occurs over a particular time period. Suppose that you purchased a share of Target, TGT, at the beginning of January 2020 for $128, $74. At the end of the year, you sold the stock for $176, $53, which was $47, $79 more than you paid for it. This increase in value is known as a capital gain. As the owner of the stock, you also received $2.68 in dividends during 2020. The total dollar return from your investment is calculated as total dollar return equals dividend income, capital gain equals $2.68 plus 47. 79 equals 50. 47.15. One, it is common to express investment returns in percentage terms rather than dollar terms. This allows you to answer the question, how much do I receive for each dollar invested, so that you can compare investments of different sizes. The total percent return from your investment is total percent return equals dividend yield plus capital gain yield equals 2. 68 128, 74 plus 47, 79 128, 74 equals 0, 208 plus 0, 3,712 equals 0, 3,920 equals 39, 20% 15. 2. The dividend yield is calculated by dividing the dividends you received by the initial stock price. This calculation says that for each dollar invested in TGT in 2020, you received $0, $208 in dividends. The capital gain yield is the change in the stock price divided by the initial stock price. This calculation says that for each dollar invested in TGT in 2020, you received $0, $3,712 in capital gains. Your total percent return of 39. 20% means that you made $0, $392 for every dollar invested when your gains from both dividends and stock price appreciation are totaled together. Think it through calculating return. You purchased 10 shares of 3M stock in January 2020 for $175 per share, received dividends of $5.91 per share, and sold the stock at the end of the year for $169.72 per share. Calculate your total dollar return, your dividend yield, your capital gain yield, and your total percent yield. Of course, investors seldom purchase a stock and then sell it exactly 1 year later. Assume that you purchased shares of Facebook, FB, on June 1, 2020 for $228.50 per share and sold the shares 3 months later for $261.90. You received no dividends. In this case, your holding period percentage return is calculated as 261.90 minus $228.50 $228.50 equals 0. 1,462 equals 14. 62% 15. For this 62% is your return for a 3-month holding period. To compare them to other investment opportunities, you need to express returns on a per year or annualized basis. The holding period returned is converted to an effective annual rate, EAR, using the formula EAR equals 1 plus holding period percentage return, letter 1D45A minus 115. 5, where M is the number of holding periods in a year. There are 4 3-month periods in a year. So, the EAR for this investment is EAR equals 1 plus 0. 1,462, 4 minus 1 equals 0. 7,260 equals 72. 60% 15. 6. What happens if you own a stock for more than 1 year? Your holding period return would have occurred over a period longer than a year, but the process to calculate the EAR is the same. Suppose you purchased shares of FB in May 2015 when it was selling for $79.30 per share. You held the stock until May 2020 when you sold it for $224.59. Your holding period percentage return would be 224. 59 minus 79. 30 79. 30 equals 183.22%. You more than tripled your money, but it took you 5 years to do so. Your EAR, which will be smaller than this 5-year holding period return rate, is calculated as EAR equals 1 plus 1. 83.22. 15 minus 1 equals 23. 15% 15. 7 average annual returns. Suppose that you purchased shares of Delta Airlines, DAL, at the beginning of 2011 for $11.19 and held the stock for 10 years before selling it for $40. $21. You made 40. 21 minus 11. 19 equals 29. 2 on your investment over a 10-year period. This is a 259. 34% holding period return. The EAR for this investment is EAR equals 1 plus 2. 59 34. 110 minus 1 equals 13. 65% 15. 8. To calculate the EAR using the above formula, the holding period return must first be calculated. The holding period return represents the percentage return earned over the entire time the investment is held. Then, the holding period return is converted to an annual percentage rate using the formula. You can also use the basic time value of money formula to calculate the EAR on an investment. In time value of money language, the initial price paid for the investment, $11.19, is the present value. The price the stock is sold for, $40. $21 is the future value. It takes 10 years for the $11.19 to grow to $40. $21. Using the time value of money will result in a calculation of PV times 1 plus letter 1D456, letter 1D45B equals FV1. 19 times 1 plus letter 1d 4 5 6 10 equals 40. 21 1 plus I equals 359,340. 10I equals 13. 65% 15. 9 The ear formula and the time value of money both result in a 13. 65% annual return. Mathematically, the two formulas are the same. One is simply an algebraic rearrangement of the other. If you earned 65% each year, compounded for 10 years, you would have converted your $11. $19 per share investment to $40. 21 per share. Of course, doll stock did not increase by exactly 65% each year. The returns for doll for each year are shown in Table 15. 1. Some years the return was much higher than 65%. In 2013, the return was almost 133%. Other years, the return was much lower than 65%. In fact, the return was negative in 4 of the years. Year return value of investment, initial investment of 11. 2011 minus 0. 3579 719 2012 0. 4672 10. 54 2013 132 61 24. 52 2014 0 80 53 44. 27 2015 0. 405 46. 6 2016 minus 0. 135 45. 44 2017 0 16 23 52. 81 2018 minus 0. 866 48. 24 2019 0. 2030 858. 7 2020 minus 0. 30 77 40. 20 Table 15. 1 Yearly returns for doll, 2011-2020. Value of initial investment at each year end, although an investment in doll of $11. $19 at the beginning of 2011 grew to $40. 20 by the end of 2020, this growth was not consistent each year. The amount that the stock was worth at the end of each year is also shown in Table 15. 1. During 2011, the return for doll was minus 79%, resulting in the value of the investment falling to 11. 19 times 1 plus minus 0. 3579, 7, 19. The following year, 2012, the return for doll was 72%. Therefore, the value of the investment was 7. 19 times 1 plus 0. 4672 equals 10, $54 at the end of 2012. This process continues each year that the stock is held. The compounded annual return derived from the year and time value of money formulas is also known as a geometric average return. A geometric average return is calculated using the formula geometric average return equals 1 plus R1 times 1 plus R2 times 1 plus Rn. 1n minus 115. 10, where Rn is the return for each year in the time period for which the average is calculated. The calculation of the geometric average return for doll is shown in the right column of Table 15. 2. The slight difference in the geometric average return of 64% from the 65% derived from the year and time value of money calculations is due to rounding errors. Year return 1 plus return 2011 minus 0. 3579 0, 64 21 2012 0. 4672 1 4672 2013 1. 3261 2. 3261 2014 0 80 53 1 80 53 2015 0. 4051. 405 2016 minus 0. 135 0 98 65 2017 0 16 23 1. 16 23 2018 minus 0. 866 0. 9134 2019 0. 2038 1 2038 2020 minus 0. 3077 0. 6923 arithmetic AVG 0 2243. 5928 product of 1 plus return SDD Dev 0. 5191 1364 product raised to 1N0 1364 geometric average Table 15. 2 Yearly returns for doll 2011-2020. with calculation of the arithmetic mean, standard deviation, and geometric mean looking at Table 15. 2. You will notice that the geometric average return differs from the mean return. Adding each of the annual returns and dividing the sum by 10 results in a 4% average annual return. This 4% is called the arithmetic average return. The geometric average return will be smaller than the arithmetic average return unless the returns for all years are identical. This is due to the basic arithmetic of compounding. Think of a very simple example in which you invest $100 for 2 years. If you have a positive return of 50% the first year and a negative 50% return the second year, you will have an arithmetic average return of 0. 5 plus minus 0. 52 equals 0%, but you will have a geometric average return of 1 plus 0, 5 times 1 minus 0. 5, 0. 5 minus 1 equals minus 13. 4%. With a 50% positive return the first year, you ended the year with $150. The second year, you lost 50% of that balance and were left with only $75. Another important fact when studying average returns is that the order in which you earn the returns is not important. Consider what would have occurred if the returns in the 2 years were reversed, so that you faced a loss of 50% in the first year of your investment and a gain of 50% in the second year of your investment. With a minus 50% return in the first year, you would have ended that year with only $50. Then, if that $50 earned a positive 50% return the second year, you would have a $75 balance at the end of the 2-year period. A negative return of 50% followed by a positive return of 50% still results in an arithmetic average return of 0% and a geometric average return of 1 minus 0. 5 times 1 plus 0. 5, 0. 5 minus 1 equals minus 13. 4%. Think it through. Calculating arithmetic and geometric average return the annual returns for CVS Health Corp. CVS, for the 10-year period of 2011-2020, are shown in Table 15. 3-year returns 2011-18, 94% 2012-20, 28% 2013-50, 38% 2014-37, 12% 2015-2, 90% 2016-17, 83% 2017-5, 75% 2018-7, 4% 2019-17, 26% 2020-5, 14% Table 15. 3 CVS annual returns, 2011-2020. Source: Yahoo! Finance. What was the arithmetic average return during the decade? What was the geometric average return during the decade? Solution: see Table 15. 4 for the arithmetic mean and geometric mean calculations. Arithmetic average calculation, geometric average calculation, year return, 1 plus return 2011 0, 1894 1. 1894, 2012 0. 2020 8 1. 2028, 2013 0, 50 30, 8 1 50 30, 8 2014 0. 37 12 1. 37 12, 2015, 0 291 2 90 2016, minus 0. 17 80 30. 82 17 2017, minus 0. 575 094 25 2018, minus 0. 704 092 96 2019, 017 26 1. 17 26 2020, minus 0. 514 0. 9486, sum of returns 111 12 2. 4309, product of 1 plus return, sum divided by 10 0. 11 11 1. 929, raise product to 110, arithmetic average 11. 11% 0. 929, subtract 19. 29%, geometric average, Table 15. 4 yearly returns for CVS, 2011-2020, the arithmetic average return for CVS was 11%, and the geometric average return was 29%. Both the arithmetic average return and the geometric average return are correct calculations. They simply answer different questions. The geometric average tells you what you actually earned per year on average, compounded annually. It is useful for calculating how much a particular investment grows over a period of time. The arithmetic average tells you what you earned in a typical year. When we are looking at the historical description of the distribution of returns and want to predict what to expect in a particular year, the arithmetic average is the relevant calculation. Measuring risk, although the arithmetic average return for Delta Airlines, DAL, for 2011-2020 was 22.4%, there is not a year in which the return was exactly 22.4%. In fact, in some years, the return was much higher than the average, such as in 2013, when it was 132.61%. In other years, the return was negative, such as 2011, when it was minus 35.79%. Looking at the yearly returns in Table 15.2, the return for DAL varies widely from year to year. In finance, this volatility of returns is considered risk. Volatility of returns, the most commonly used measure of volatility of returns in finance, is the standard deviation of the returns. The standard deviation of returns for DAL for the sample period 2011-2020 is 51.9%. Remember that if the normal distribution, a bell-minus shaped curve, describes returns, then 68%, or about 2/3 of the time, the return in a particular year will be within one standard deviation above and one standard deviation below the arithmetic average return. Given DAL's average return of 22.4%, the actual yearly return will be somewhere between minus 29.5% and 74.29% in 2 out of 3 years. A very high return of greater than 74.29% would occur 16% of the time. A very large loss of more than 29.5% would also occur 16% of the time. As you can see, there is a wide range of what can be considered a typical year for DAL. Although we can calculate an average return, the return in any particular year is likely to vary from that average. The larger the standard deviation, the greater this range of returns is. Thus, a larger standard deviation indicates a greater volatility of returns and hence more risk. Think it through. Calculating the standard deviation of returns, you calculated the arithmetic average return for CVS to be 11% for the 10-year period of 2011-2020. Calculate the standard deviation of returns for CVS for the same period, see Table 15.5. What does this tell you about what an investor in CVS experienced in a typical year during that decade? Solution: year return minus mean squared difference 2011 0 1894 0 783 0 61 2012 0 2028 0 9 17 0 84 2013 0 50 38 0 39 27 0 1542 2014 0 3712 0 26 010 676 2015 0290 -0 821 067 2016 -0 1783 -0 2894 0 838 2017 -0 575 -0 1686 0 284 2018 -0 704 -0 1815 0 329 2019 017 26 0 615 038 2020 -0 514 -0 1625 0 264 mean 0 1111 0 4185 sum of squared differences 0 465 sum divided by n 10 2156 square root table 15. 5 standard deviation of CVS returns. The standard deviation of returns for CVS during the sample period of 2011-2020 was 21.56%, with an arithmetic average return of 11%, the return would lie between -10.45% and 32.67% in about 2 out of 3 years. Even though the average return is 11%, a return in a particular year might be much higher or much lower than that average. In fact, a loss of more than 10 45% would be expected about once every 6 years. Also, about once every 6 years, a return greater than 32. 67% would be expected. Firm-specific risk: investors purchase a share of stock hoping that the stock will increase in value and they will receive a positive return. You can see, however, that even with well-established companies such as ExxonMobil and CVS, returns are highly volatile. Investors can never perfectly predict what the return on a stock will be, or even if it will be positive. The yearly returns for 4 companies, Delta Airlines (DAL), Southwest Airlines, LOVE, ExxonMobil (XOM), and CVS Health Corp. (CVS), are shown in Table 15. 6. Each of these stocks had years in which the performance was much better or much worse than the arithmetic average. In fact, none of the stocks appear to have a typical return that occurs year after year. 2 stock portfolio, year: DAL, LOVE, XOM, CVS, 2011 -35, 79% -33, 93% 1867% 18, 94% 2012 46, 72% 20, 3% 470% 20, 28% 2013 132, 61% 85, 38% 20, 12% 50, 38% 2014 80, 53% 126, 47% -6, 6% 37, 12% 2015 4, 5% 2 43% -12, 79% 2 90% 2016 -1, 35% 16, 72% 19, 88% -17, 83% 2017 16, 23% 32, 41% -3, 81% -5, 75% 2018 -8, 66% -28, 28% -15, 9% -7, 4% 2019 20, 38% 17, 69% 7, 23% 17, 26% 2020 -30, 77% -13, 4% -36, 21% -5, 14% average 22, 40% 22, 59% -0, 34% 11, 11% STD Dev 51, 90% 49, 84% 18 18% 21, 56% Table 15. 6 yearly returns for DAL, LOVE, XOM, and CVS. Source: Yahoo Finance, Figure 15. 2 contains a graph of the returns for each of these 4 stocks by year. In this graph, it is easy to see that DAL and LOVE both have more volatility, or returns that vary more from year to year, than do XOM or CVS. This higher volatility leads to DAL and LOVE having higher standard deviations of returns than XOM or CVS. A bar graph that shows yearly returns for DAL, LOVE, XOM, and CVS. The graph shows returns from 2011 through 2020. The graph shows that DAL and LOVE both have more volatility or returns that vary from year to year than do XOM or CVS. DAL and LOVE both have negative returns in 2011, high returns in 2012 and 2013. The returns for XOM and CVS are consistently between approximately 20% and 40% during this time period. The returns for all companies from 2015 through 2019 range from -10% to just over 20%. All companies show negative returns in 2020. Figure 15. 2 yearly returns for DAL, LOVE, XOM, and CVS. Data source: Yahoo Finance. Standard deviation is considered a measure of the risk of owning a stock. The larger the standard deviation of a stock's annual returns, the further from the average that stock's return is likely to be in any given year. In other words, the return for the stock is highly unpredictable. Although the return for CVS varies from year to year, it is not subject to the wide swings of the returns for DAL or LOVE. Why are stock returns so volatile? The value of the stock of a company changes as the expectations of the future revenues and expenses of the company change. These expectations may change due to a number of events and new information. Good news about a company will tend to result in an increase in the stock price. For example, Dahl announcing that it will be opening new routes and flying to cities it has not previously serviced suggests that Dahl will have more customers and more revenue in future years. Or if CVS announces that it has negotiated lower rent for many of its locations, investors will expect the expenses of the company to fall, leading to more profits. Those types of announcements will often be associated with a higher stock price. Conversely, if the pilots and flight attendants for Dahl negotiate higher salaries, the expenses for Dahl will increase, putting downward pressure on profits and the stock price. Link to Learning Peloton and Risk, an example of how news can impact the price of a stock occurred on May 5, 2021, when Peloton recalled all of its Tread Plus and Tread products after the tragic death of a child and 70 injuries associated with use of its products. The previous day, Peloton stock traded for $96, $70 per share. The stock price dropped approximately 15% when the recall was announced. The closing price for a share of Peloton on May 5 was $82, $62, $2. You can read the company's statement about this recall online. Learning outcomes. By the end of this section, you will be able to explain the benefits of diversification, describe the relationship between risk and return for large portfolios, compare firm-specific and systematic risk, discuss how portfolio size impacts risk, diversification. So far, we have looked at the return and the volatility of an individual stock. Most investors, however, own shares of stock in multiple companies. This collection of stocks is known as a portfolio. Let's explore why it is wise for investors to hold a portfolio of stocks rather than to pick just one favorite stock to own. We saw that investors who owned Dahl experienced an average annual return of 87%, but also a large standard deviation of 16%. Investors who used all their funds to purchase Dahl stock did exceptionally well during 2012-2014. But in 2020, those investors lost almost one-third of their money as COVID-19 caused a sharp reduction in air travel worldwide. To protect against these extreme outcomes, investors practice what is called diversification, or owning a variety of stocks in their portfolios. Suppose, for example, you have saved $50,000 that you want to invest. If you purchased $50,000 of Dahl stock, you would not be diversified. Your return would depend solely on the return on Dahl stock. If instead, you used $5,000 to purchase Dahl stock and used the remaining $45,000 to purchase 9 other stocks, you would be diversifying. Your return would depend not only on Dahl's return, but also on the returns of the other 9 stocks in your portfolio. Investors practice diversification to manage risk. It is akin to the saying, "Don't put all of your eggs in one basket." If you place all of your eggs in one basket and that basket breaks, all of your eggs will fall and crack. If you spread your eggs out across a number of baskets, it is unlikely that all of the baskets will break and all of your eggs will crack. One basket may break, and you will lose the eggs in that basket, but you will still have your other eggs. The same idea holds true for investing. If you own stock in a company that does poorly, perhaps even goes out of business, you will lose the money you placed in that particular investment. However, with a diversified portfolio, you do not lose all your money because your money is spread out across a number of different companies. Link to Learning. Diversification. Fidelity Investments, Inc. is a multinational financial services firm and one of the largest asset managers in the world. In this educational video for investors, Fidelity provides an explanation of what diversification is and how it impacts an investor's portfolio. Table 15.7 shows the returns of investors who placed 50% of their money in Dahl and the remaining 50% in Love, XOM, or CVS. Notice that the standard deviation of returns is lower for the 2-stock portfolios than for Dahl as an individual investment. 2-stock portfolio. Year Dahl and Love Dahl and Zom Dahl and CVS. 2011, minus 35. 79% minus 34. 86% minus 8. 56% minus 8. 43%. 2012, 46. 72% 33. 38% 25. 71% 33. 50%. 2013, 132. 61% 109, 0% 76, 36% 91, 50%. 2014 80, 53% 103, 50% 37, 24% 58, 83%. 2015 4, 0.5% 3, 24% minus 4, 37% 3, 47%. 2016 minus 1, 35% 7, 69% 9, 27% minus 9, 59%. 2017 16, 23% 24, 32% 6, 21% 5, 24%. 2018 minus 8, 66% minus 18, 47% minus 11, 88% minus 7, 85%. 2019 20, 38% 19, 0.3% 13, 81% 18, 82%. 2020 minus 30, 77% minus 21, 90% minus 33, 49% minus 17, 95%. Average 22, 40% 22, 49% 11, 0.3% 16, 75%. STD Dev 51, 90% 49, 11% 30, 43% 35, 10%. Table 15. 7 yearly returns for Doll versus a 2-stock portfolio containing Doll and Love, XOM or CVS data source. Yahoo Finance. As investors diversify their portfolios, the volatility of one particular stock becomes less important. XOM has good years with above-average returns and bad years with below-average, and even negative returns, just like Doll. But the years in which those above-average and below-average returns occur are not always the same for the two companies. In 2014, for example, the return for Doll was greater than 80%, while the return for XOM was negative. On the other hand, in 2011, when Doll had a return of minus 15%, XOM had a positive return. When more than one stock is held, the gains in one stock can offset the losses in another stock, washing away some of the volatility. When an investor holds only one stock, that one stock's volatility contributes 100% to the portfolio's volatility. When two stocks are held, the volatility of each stock contributes to the volatility of the portfolio. However, the volatility of the portfolio is not simply the average of the volatility of each stock held independently. How correlated the two stocks are, or how much they move together, will impact the volatility of the portfolio. You will recall from our study of correlation in regression analysis, in finance, that a correlation coefficient describes how two variables move relative to each other. A correlation coefficient of 1 means that there is a perfect, positive correlation between the two variables, while a correlation coefficient of -1 means that the two variables move exactly opposite of each other. Stocks that are in the same industry will tend to be more strongly correlated than stocks that are in much different industries. During the 2011-2020 time period, the correlation coefficient for Doll and Love was 0.87. The correlation coefficient for Doll and XOM was 0.35, and the correlation coefficient for Doll and CVS was 0.79. Combining stocks that are not perfectly positively correlated in a portfolio decreases risk. Notice that investors who owned Doll and Love from 2011 to 2020 would have had a lower portfolio standard deviation, but not much lower than investors who just owned Doll. Because the correlation coefficient is less than 1, the standard deviation fell. However, because the two stocks are in the same industry and exposed to many of the same economic issues, the correlation coefficient is relatively high, and combining those two stocks provides only a small decrease in risk. This is because, as airlines, Doll and Love face many of the same market conditions. In years when the economy is strong, the weather is good, fuel prices are low, and people are traveling a lot, both companies will do well. When something such as bad weather conditions reduces the amount of air travel for several weeks, both companies are harmed. By holding Love in addition to Doll, investors can reduce exposure to risk that is specific to Doll, perhaps a problem that Doll has with its reservation system, but they do not reduce exposure to the risk associated with the airline industry, perhaps rising jet fuel prices. Dahl and Love tend to experience positive returns in the same years and negative returns in the same years. On the other hand, investors who added XOM to their portfolio saw a significantly lower standard deviation than those who held just Dahl. In years when jet fuel prices rise, harming the profits of both Dahl and Love, XOM is likely to see high profits. Diversifying a portfolio across firms that are less correlated will reduce the standard deviation of the portfolio more. Link to learning how to build a diversified portfolio. TV personality, former hedge fund manager, and author Jim Cramer encourages investors to build a diversified portfolio, having no more than 20% of a portfolio in one sector. 3. Watch this CNBC video to learn more about how he suggests investors can build a diversified portfolio by purchasing 5 to 10 stocks. Portfolio, size, and risk. As you add more stocks to a portfolio, the volatility, or standard deviation, of the portfolio decreases. The volatility of individual assets becomes less and less important. As we discussed earlier, the risk that is associated with events related to a particular company is called firm-specific risk or unsystematic risk. Examples of unsystematic risk would include a company facing a product liability lawsuit, a company inventing a new product, or accounting irregularities being detected. Holding a portfolio of stocks means that if one company you have invested in goes out of business because of poor management, you do not lose all your savings because some of your money is invested in other companies. Portfolio diversification protects you from being significantly impacted by unsystematic risk. However, there is a level below which the portfolio risk does not drop, no matter how diversified the portfolio becomes. The risk that never goes away is known as systematic risk. Systematic risk is the risk of holding the market portfolio. We have talked about reasons why a firm's returns might be volatile. For example, the firm discovering a new technology or having a product liability lawsuit brought against it will impact that firm specifically. There are also events that broadly impact the stock market. Changes in the Federal Reserve Bank's monetary policy and interest rates impact all companies. Geopolitical events, major storms, and pandemics can also impact the entire market. Investors in stocks cannot avoid this type of risk. This unavoidable risk is the systematic risk that investors in stocks have. This systematic risk cannot be eliminated through diversification. In addition, as per research conducted by Mayer Statman, the standard deviation of a portfolio drops quickly as the number of stocks in the portfolio increases from 1 to 2 or 3. See Figure 2 illustration in this subsequent article by Statman for context. Increasing the size of the portfolio decreases the standard deviation, and thus the risk, of the portfolio. However, as the portfolio increases in size, the amount of risk reduced by adding one more stock to the portfolio will decrease. How many stocks does an investor need for a portfolio to be well diversified? There is not an exact number that all financial managers agree on. A portfolio of 15 highly correlated stocks will offer less benefits of diversification than a portfolio of 10 stocks with lower correlation coefficients. A portfolio that consists of American Airlines, Spirit Airlines, United Airlines, Southwest Airlines, Delta Airlines, and JetBlue, along with a few other stocks, is not very diversified because of the heavy concentration in the airline industry. The term diversified portfolio is a relative concept, but the average investor can create a reasonably diversified portfolio with approximately a dozen stocks. Learning outcomes. By the end of this section, you will be able to define risk premium, explain the concept of beta, compute the required return of a security using the CAPM, risk-free rate, the capital asset pricing model. CAPM is a financial theory based on the idea that investors who are willing to hold stocks that have higher systematic risk should be rewarded more for taking on this market risk. The CAPM focuses on systematic risk rather than a stock's individual risk because firm-specific risk can be eliminated through diversification. Suppose that your grandparents have given you a gift of $20,000. After you graduate from college, you plan to work for a few years and then apply to law school. You want to use the $20,000 your grandparents gave you to pay for part of your law school tuition. It will be several years before you are ready to spend the money, and you want to keep the money safe. At the same time, you would like to invest the money and have it grow until you are ready to start law school. Although you would like to earn a return on the money so that you have more than $20,000 by the time you start law school, your primary objective is to keep the money safe. You are looking for a risk-free investment. Lending money to the U.S. government is considered the lowest risk investment that you can make. You can purchase a U.S. Treasury security. The chances of the U.S. government not paying its debts is close to zero. Although, in theory, no investment is 100% risk-free. Investing in U.S. government securities is generally considered a risk-free investment because the risk is so minuscule. The rate that you can earn by purchasing U.S. Treasury securities is a proxy for the risk-free rate. It is used as an investing benchmark. The average rate of return for the 3-month U.S. Treasury security from 1928 to 2020 is 36%. 5. You can see that you will not become immensely wealthy by investing in U.S. Treasury bills. Another characteristic of U.S. Treasury securities, however, is that their volatility tends to be much lower than that of stocks. In fact, the standard deviation of returns for the U.S. Treasury bills is 30%. Unlike the returns for stocks, the return on U.S. Treasury bills has never been negative. The lowest annual return was 0.3%, which occurred in 2014. 6. Link to learning. U.S. Treasury securities. Visit the website of the U.S. Department of the Treasury to learn more about U.S. Treasury securities. You will find current interest rates for both short-term securities, U.S. Treasury bills, and long-term securities, U.S. Treasury bonds. Risk premium. You know that if you use your $20,000 to invest in stock rather than in U.S. Treasury bills, the outcome of the investment will be uncertain. Your investments may do well, but there is also a risk of losing money. You will only be willing to take on this risk if you are rewarded for doing so. In other words, you will only be willing to take the risk of investing in stocks if you think that doing so will make you more than you would make investing in U.S. Treasury securities. From 1928 to 2020, the average return for the S&P 500 stock index has been 11.64%, which is much higher than the 3.36% average return for U.S. Treasury bills. 7 stock returns with a standard deviation of 19.49%, however, have also been much more volatile. In fact, there were 25 years in which the return for the S&P 500 index was negative. You may not be willing to take the risk of losing some of the money your grandparents gave you because you have been setting it aside for law school. If that's the case, you will want to invest in U.S. Treasury securities. You may have money that you are saving for other long-term goals, such as retirement, with which you are willing to take some risk. The extra return that you will earn for taking on risk is known as the risk premium. The risk premium can be thought of as your reward for being willing to bear risk. The risk premium is calculated as the difference between the return you receive for taking on risk and what you would have returned if you did not take on risk. Using the average return of the S&P 500 to measure what investors who bear the risk earn, and the U.S. Treasury bill rate to measure what investors who do not bear risk earn. The risk premium is calculated as risk premium equals S&P 500 AVG return minus USD bill AVG return equals 11.64% minus 3.36% equals 8.28%. 15.11. Beta. The risk premium represents how much an investor who takes on the market portfolio is rewarded for risk. Investors who purchase one stock doll, for example, experience volatility, which is measured by the standard deviation of that stock's returns. Remember that some of that volatility, the volatility caused by firm-specific risk, can be diversified away. Because investors can eliminate firm-specific risk through diversification, they will not be rewarded for that risk. Investors are rewarded for the amount of systematic risk they incur. Interpreting beta. The relevant risk for investors is the systematic risk they incur. The systematic risk of a particular stock is measured by how much the stock moves with the market. the measure of how much a stock moves with the market is known as its beta. A stock that tends to move in sync with the market will have a beta of 1. For these stocks, if the market goes up 10%, the stock generally also goes up 10%. If the market goes down 5%, stocks with a beta of 1 also tend to go down 5%. If a company has a beta greater than 1, then the stock tends to have a more pronounced move in the same direction as a market move. For example, if a stock has a beta of 2, the stock will tend to increase by 20% when the market goes up by 10%. If the market falls by 5%, that same stock will tend to fall by twice as much, or 10%. Thus, stocks with a beta greater than 1 experience greater swings than the overall market and are considered to be riskier than the average stock. On the other hand, stocks with a beta less than 1 experience smaller swings than the overall market. A beta of 0.5, for example, means that a stock tends to experience moves that are only 50% of overall market moves. So, if the market increases by 10%, a stock with a beta of 0.5 would tend to rise by only 5%. A market decline of 5% would tend to be associated with a 2.5% decrease in the stock. Calculating betas. The calculation of beta for DAL is demonstrated in Figure 15. 3 monthly returns for DAL and for the S&P 500 are plotted in the diagram. Each dot in the scatter plot corresponds to a month from 2018 to 2020. For example, the dot that lies furthest in the upper right-hand corner represents November 2020. The return for the S&P 500 was 10.88% that month. This return is plotted along the horizontal axis. The return for DAL during November 2020 was 31.36%. This return is plotted along the vertical axis. You can see that generally, when the overall stock market as measured by the S&P 500 is positive, the return for DAL is also positive. Likewise, in months in which the return for the S&P 500 is negative, the return for DAL is also usually negative. Drawing a line that best fits the data, also known as a regression line, summarizes the relationship between the returns for DAL and the S&P 500. The slope of this line, 139, is DAL's beta. Beta measures the amount of systematic risk that DAL has. A scatter plot shows monthly returns for DAL and the S&P 500. A regression line shows the correlation between the DAL returns and the S&P 500 returns. Figure 15. 3 calculation of beta for DAL data source, Yahoo. Finance, CAPM equation. Because DAL's beta of 1.39 is greater than 1, DAL is riskier than the average stock in the market. Finance theory suggests that investors who purchase DAL will expect a higher rate of return to compensate them for this risk. DAL has 139% of the average stock's systematic risk. Therefore, investors in the stock should receive 139% of the market risk premium. The capital asset pricing model, CAPM, equation is letter 1D445, E equals letter 1D445F, beta times market risk premium. Letter 1D445, E equals letter 1D445F, beta times letter 1D445M minus letter 1D445F. 15. 12. Where RAE is the expected return of the asset, RF is the risk-free rate of return, and RM is the expected return of the market. Given the average S&P 500 return of 11.64% and the average U.S. Treasury bill return of 3.36%, the expected return of DAL would be calculated as letter 1D445 E equals letter 1D445 UST bill plus beta times RS and P minus Rust bill. Letter 1D445 E equals 0. 336 plus 1, 39 times 0, 1164 minus 0, 336 equals 14, 87%. 15, 13. Link to learning. Calculating beta. Many providers of stock data and investment information will list a company's beta. 2 internet sources that can be used to find a company's beta are Yahoo, Finance, and MarketWatch. Various sources may not provide the exact same value for beta for a company. For example, in early February 2021, Yahoo Finance reported that the beta for DAL was 1.468, while MarketWatch reported it as 1.29. 9. Both of these numbers are slightly different from the 139 calculated in the graph above. There are several reasons why beta may vary slightly from source to source. One is the time frame used in the beta calculation. Data from 3 years were used to calculate the beta in Figure 15. 3 time frames ranging from 3 to 5 years are commonly used when calculating beta. Another reason different sources might report different betas is the frequency with which the data is collected. Monthly returns are used in Figure 15.3. Some analysts will use weekly data. Finally, the S&P 500 is used to measure the market return in Figure 15.3. The S&P 500 is one of the most common measures of overall market returns, but alternatives exist and are used by some analysts. Link to learning. CAPM. Watch this video for further information about the CAPM. Learning outcomes. By the end of this section, you will be able to interpret a Sharpe ratio, interpret a trainer measurement, interpret Jensen's alpha, Sharpe ratio. Investors want a measure of how good a professional money manager is before they entrust their hard-earned funds to that professional for investing. Suppose that you see an advertisement in which McKinley Investment Management claims that the portfolios of its clients have an average return of 20% per year. You know that this average annual return is meaningless without also knowing something about the riskiness of the firm's strategy. In this section, we consider some ways to evaluate the riskiness of an investment strategy. A basic measure of investment performance that includes an adjustment for risk is the Sharpe ratio. The Sharpe ratio is computed as a portfolio's risk premium divided by the standard deviation of the portfolio's return, using the formula. Sharpe ratio equals RP minus letter 1D445F, letter 1D70EP. 15. 14. The portfolio risk premium is the portfolio return RP minus the risk-free return RF. This is the basic reward for bearing risk. If the risk-free return is 3%, McKinley Investment Management's clients who are earning 20% on their portfolios have an excess return of 17%. The standard deviation of the portfolio's return, letter 1D70EP, is a measure of risk. Although you see that McKinley's clients earn a nice 20% return on average, you find that the returns are highly volatile. In some years, the clients earn much more than 20%, and in other years, the return is much lower, even negative. That volatility leads to a standard deviation of returns of 26%. The Sharpe ratio would be 17%, 26%, or 0.65. Thus, the Sharpe ratio can be thought of as a reward-to-risk ratio. The standard deviation in the denominator can be thought of as the units of risk the investor has. The numerator is the reward the investor is receiving for taking on that risk. Link to learning. Sharpe ratio. The Sharpe ratio was developed by Nobel laureate William F. Sharpe. You can visit Sharpe's Stanford University website to find videos in which he discusses financial topics and links to his research, as well as his advice on how to invest. Trainer measurement of performance. Another reward-to-risk ratio measurement of investment performance is the trainer ratio. The trainer ratio is calculated as trainer ratio equals RP minus letter 1D445F, letter 1D6FDP. 15. 15. Just as with the Sharpe ratio, the numerator of the trainer ratio is a portfolio's risk premium. The difference is that the trainer ratio focuses on systematic risk, using the beta of the portfolio in the denominator, while the Sharpe ratio focuses on total risk, using the standard deviation of the portfolio's returns in the denominator. If McKinley Investment Management has a portfolio with a 20% return over the past 5 years, with a beta of 1.2 and a risk-free rate of 3%, the trainer ratio would be 0.20 minus 0.3. 1.2 equals 0.14. Both the Sharpe and trainer ratios are relative measures of investment performance, meaning that there is not an absolute number that indicates whether an investment performance is good or bad. An investment manager's performance must be considered in relation to that of other managers or to a benchmark index. Jensen's alpha. Jensen's alpha is another common measure of investment performance. It is computed as the raw portfolio return minus the expected portfolio return predicted by the CAPM. Jensen's alpha equals letter 1d6FCP equals RP minus Ray equals letter 1d445P minus letter 1d445F plus letter 1d6FD P letter 1d445M minus letter 1d445F. 15. 16. Suppose that the average market return has been 12%. What would Jensen's alpha be for McKinley Investment Management's portfolio with a 20% average return and a beta of 1-2? Letter 1d6FC McKinley equals 0, 2 minus 0, 3 plus 1, 2, 0, 12 minus 0, 3 equals 0. 62. 15. 17. Unlike the Sharpe and Trainer ratios, which are meaningful in a relative sense, Jensen's alpha is meaningful in an absolute sense. An alpha of 0. 62 indicates that the McKinley Investment Management portfolio provided a return that was 2% higher than would be expected given the riskiness of the portfolio. A positive alpha indicates that the portfolio had an abnormal return. If Jensen's alpha equals 0, the portfolio return was exactly what was expected given the riskiness of the portfolio as measured by beta. Think it through. Comparing the returns and risks of portfolios, you are interviewing two investment managers. Mr. Wang shows that the average return on his portfolio for the past 10 years has been 14%, with a standard deviation of 8% and a beta of 1. 2. Ms. Petrov shows that the average return on her portfolio for the past 10 years has been 16%, with a standard deviation of 10% and a beta of 1. 6. You know that over the past 10 years, the U.S. Treasury security rate has averaged 2%, and the return on the S&P 500 has averaged 11%. Which portfolio manager do you think has done the better job? Solution: the Sharpe ratio for Mr. Wang's portfolio is 14% minus 2%, 8% equals 1, 5, and the Trainer ratio is 14% minus 2%, 1, 2 equals 10. The Sharpe ratio for Ms. Petrov's portfolio is 16% minus 2%, 10% equals 1, 4, and the Trainer ratio is 16% minus 2%, 1, 6 equals 875. Jensen's alpha for Mr. Wang's portfolio is letter 1d6FC Wang equals 0, 14 minus 0, 2 plus 1, 2, 0, 11 minus 0, 2 equals 0, 12, 15, 18. Jensen's alpha for Ms. Petrov's portfolio is letter 1d6FC Petrov equals 0, 16 minus 0, 2 plus 1, 6, 0, 11 minus 0, 2 equals minus 0, 4, 15, 19. All three measures of portfolio performance suggest that Mr. Wang's portfolio has performed better than Ms. Petrov's has. Although Ms. Petrov has had a larger average return, the portfolio she manages is riskier. Ms. Petrov's portfolio is more volatile than Mr. Wang's, resulting in a higher standard deviation. Ms. Petrov's portfolio has a higher beta, which means it has a higher amount of systematic risk. The CAPM suggests that a portfolio with a beta of 1.6 should have an expected return of 16.4%. Because Ms. Petrov's portfolio has an average return of less than that, investors in Ms. Petrov's portfolio are not rewarded for the risk that they have taken as much as would be expected. Learning outcomes. By the end of this section, you will be able to calculate the average return and standard deviation for a stock, calculate the average return and standard deviation for a portfolio, calculate the beta of a stock, average return and standard deviation for a single stock. Excel can be used to calculate the average returns and the standard deviation of returns for both a single stock and a portfolio of stocks. It can also be used to calculate the beta for a stock. Historic stock price data for stocks you are interested in analyzing can easily be downloaded from sites such as Yahoo Finance into Excel. The examples in this section use monthly stock data from December 2017 to December 2020 from Yahoo Finance. Monthly price data for AMZN Amazon is shown in column B of figure 15. 4. To begin, monthly returns must be calculated from the price data using the formula. Monthly return, ending price minus beginning price. Beginning price, 15, 20. The ending prices shown in figure 15. 4 are the last price the stock traded for each month. Each month, the return is calculated under the assumption that you purchased the stock at the last trading price of the previous month and sold at the last price of the current month. Thus, the return for January 2018 is calculated as monthly return, Jan 2018, price minus DEC 2017 price. DEC 2017 price equals 1 450, 89 minus 1 169, 47, 1 169, 47 equals 0 2406 equals 24, 6%, 15, 21. This is accomplished in Excel by placing the formula B3B2/B2 in cell C3. This formula can then be copied down the spreadsheet through row C38. Now that each monthly return is in column C, you can calculate the average of the monthly returns in cell C39 and the standard deviation of returns in cell C40. An Excel screenshot the ending price and monthly return of Amazon's stock price for 13 months. The average monthly return is 0, 330. The standard deviation is 0, 933. Figure 15. 4. Calculating the average return and the standard deviation of returns for AMZN data source. Yahoo! Finance. Over the 3-year period, the average monthly return for AMZN was 3.3%. However, this return was highly volatile, with a standard deviation of 9.33%. Remember that this means that approximately 2/3 of the time, the monthly return from AMZN was between -6.3% and 12.63%. Download the spreadsheet file containing key Chapter 15 Excel exhibits, average return and standard deviation for a portfolio. The Excel screenshot in Figure 15.5 shows the return and standard deviation calculation for a portfolio. This sample 4-stock portfolio contains AMZN, CVS, AAPL Apple, and NFLX Netflix. This portfolio is constructed as an equally weighted portfolio. Because there are 4 stocks in this portfolio, each has a weight of 25%. The Excel screenshot shows the average return and standard deviation for a portfolio containing 4 stocks: Amazon, CVS, Apple, and Netflix. The monthly average return and standard deviation is calculated for the individual stocks, as well as the entire portfolio. It shows that the portfolio has a monthly average return of 0.269 and a standard deviation of 0.710. Figure 15.5 Calculation of the average return and standard deviation for a portfolio data source. Yahoo! Finance. The monthly returns for each stock are recorded in their respective columns. The portfolio return for each month is calculated as the weighted average of the 4 monthly individual stock returns. The formula for the portfolio return is portfolio return equals 0. 25 times RAMZN plus 0, 25 times RCVS plus 0, 25 times RAAPL plus 0, 25 times RNFLX. 15.22. The formula equals $1 asterisk B3 plus $C1 asterisk C3 plus $D1 asterisk D3 plus $E1 asterisk E3 is placed in cell F3. The formula is then copied down column F to calculate the portfolio return for each month. After the monthly portfolio return is calculated, then the average monthly portfolio return is calculated in cell F39. The average monthly portfolio return is 2.69%. Because this is an equally weighted portfolio, with each of the 4 stocks impacting the portfolio return in the same way, the average monthly portfolio return of 2.69% is the same as the sum of the average monthly returns of the 4 stocks divided by 4, or 0.330 plus 0.21 plus 0.380 plus 0.347. 4 equals 0.269 equals 269%. The standard deviation of the monthly portfolio returns is calculated in cell F40. This 4-stock portfolio has a standard deviation of 7.10%. Unlike the average return, this standard deviation is not equal to the average of the standard deviations of returns of the 4 stocks. In fact, the standard deviation for the portfolio is less than the standard deviation for any one of the 4 stocks. Remember that this occurs because the stock returns are not perfectly positively correlated. The high return of one of the stocks in one month is dampened by a lower return in another stock during the same month. Likewise, a negative return in one stock during a month might be offset by a positive return in one of the other 3 stocks during the same month. This is the risk reduction benefit of holding a portfolio of stocks. Calculating beta. The standard deviation of a stock's returns indicates the stock's volatility. Remember that the volatility is caused by both firm-specific and systematic risk. Investors will not be rewarded for firm-specific risk because they can diversify away from it. Investors are, however, rewarded for systematic risk. To determine how much of a firm's risk is due to systematic risk, you can use Excel to calculate the stock's beta. To calculate a stock's beta, you need the monthly return for the market in addition to the monthly market return for the stock. In column B in figure 15. 6. The monthly return for SPY, the SPDR S&P 500 Trust, is recorded. SPY is an ETF that was created to mimic the performance of the S&P 500 index by State Street Global Advisors and is often used as a proxy for the overall market performance. The monthly returns for AMZN are visible in column C. It is important that these returns be lined up so that the returns for a particular month for both securities appear in the same row number. Also, you want to place the returns for SPY in the column to the left of the returns for AMZN so that when you create your graph, SPY will automatically appear on the horizontal axis. Link to learning. State Street Global Advisors. You can learn more about State Street Global Advisors and its creation of the first ETF by visiting the company's history page at its website, ssga.com. You will use a scatter plot to create a graph. In Excel, go to the Insert tab, and then from the Chart menu, choose the first scatter plot option. An Excel screenshot shows how to create a scatter plot using Excel. The data for the monthly return for 2 stocks, SPY and AMZN, are placed in columns B and C, respectively. These columns are selected. On the Insert tab, the scatterplot icon is selected, revealing the different types of scatterplots available for this data. Figure 15. 6. Excel format for calculating beta data source, Yahoo Finance. Selecting the scatterplot option will result in a chart being inserted that looks like the chart in figure 15. 7. Each dot represents 1 month's combination of returns, with the return for SPY measured on the horizontal axis and the return for AMZN measured on the vertical axis. Consider, for example, the dot in the furthest upper right-hand section of the figure. This dot is the plot of returns for the month of April 2020, when the return for SPY was 36% measured on the horizontal axis, and the return for AMZN was 89% measured on the vertical axis. Hover your mouse over one of the dots and right-click the dot to pull up a chart formatting menu. This menu will allow you to add labels to your axis and polish your chart in additional ways if you would like. Select the option Add Trendline, a screenshot of scatter plot created in Excel. The scatter plot is over the data that was entered into the Excel sheet. Figure 15. 7. Creating a scatter plot in Excel data source, Yahoo Finance. When the trend line is inserted, a formatting box will appear on the right of your screen. See Figure 15. 8. If it is not already selected, choose the linear trendline option. Scroll down and select the Display Equation on Chart option. You will see the equation y equals 1477, letter 1D465 plus 0. 186 appear on the screen. This is the equation for the best fit line that shows how AMZN moves when the market moves. The slope of this line, 1477, is the beta for AMZN. This tells you that for every 10% move the overall market makes, AMZN tends to move 477%. Because AMZN tends to move a little more than the broader market, it has a little more systematic risk than the average stock in the market. A screenshot of an Excel sheet that shows the formatting box used to format a trendline for a scatter plot. Different trendline options are available to select. Figure 15. 8. Inserting a trendline to determine beta data source, Yahoo Finance.